Hi, and welcome to Random Rogers Big Picture for the week of September 14th. Back home here in Prescott, Arizona, with my very rich, dark tan. Anyway, wanted to talk about something, and I'm glad I've got the chance now to do it. It's an important thing regarding how you, I guess, measure your performance, and then how you either do or hopefully do not worry about what's going on in your account as the market is doing its thing. So for a while I had a nice streak of, quite a few several years of being ahead of the market, and as of midday on Friday, for the third quarter, so from June 30th till September 12th, for the quarter, I was trailing the S&P 500 by a little bit. It was low single digits. So, leave it at that as a number. The exact number doesn't matter. But the reason for the lag is very easy to understand. I've talked for ages about having commodity exposure, ex gold, having a Brazilian mining stock, all of these things that have added a tremendous amount of value over the last several years. And as everyone knows, over the last couple of months, that part of the market has endured a pretty aggressive decline. And while I don't think I'm making a crazy bet in terms of how much I'm allocated to that part of the market, it is enough that it helped for several years, and over the last almost 2 months, or maybe it's exactly 2 months, whatever, over the last couple of months, the weighting has been enough to create a drag on the portfolio. Hopefully I can convey with a simple facial expression how concerned I am about this, or how much time I spend worrying about this, or whatever. I'll try and do this without laughing, but here it goes. I don't care. You know how when you're sitting down when everything's going well, now of course there's going to be times where we lag the market. Well, this is one of those times. This is, rationally speaking, this is it. And if you're fairly good, you don't have to be great by any means. If you're at least mediocre, I think that's really more correct. If you are at least mediocre, there'll be times where you beat the market. There'll be times where you lag the market. If over the course of an entire market cycle, you can add value, and if you're managing your own money, only you can decide what adding value actually means. I mean, we define it in talking to clients, our idea of adding value, which is trying to smooth out the ride as best we can. So because of the pretty aggressive decline in emerging markets, commodities, mining, all of that stuff that has been getting whacked, I've got a small lag. Now, on Friday, I had a little better day than the market because all of those things had a big pop up. If you've got exposure, you probably noticed this as well. Okay, so in terms of getting back ahead of the market for the quarter, and maybe if I have time in a second, I'll say how stupid it is to be worried about 3 months at a time. But in thinking about getting back ahead of the market for the quarter, well, obviously, if all of those things, they panic down, if they start to work higher at some magnitude or velocity, if they make a lot of headway over the next couple of weeks, which is plausible, I don't know if it'll happen, but it's plausible given how long they've been falling and how aggressively they've been falling, then I'll make up that little lag and maybe move back ahead for the quarter. Still up nicely for the year, which is obviously more important than the quarter. More importantly than that is the market has puked down over the since October. in various fits and starts. I say fits and starts because at times there's been a lot of movement, and times it seems like it's done nothing, or it's actually had a couple of feel-good rallies along the way. All normal bear market stuff. And what matters, I think, at a minimum, should be the entire stock market cycle, no matter what you are doing in your account, whatever your method or approach or whatever. If it's the least bit good, there'll be times where it beats, there'll be times where it lags, and that's it. You already know this. I would expect that you know this ahead of time. If you know there are going to be periods where you lag the market, and I'll throw in there, if you know there are periods when the market's going to go down, if you know this ahead of time, this is just how the market works, it really should remove emotion from the equation. Yeah, it'd be great if the market went up all the time, but it does not. That's it. It doesn't. And if you can, understand that, know you're not always going to have the winning trades or the winning positions, it's going to make navigating much easier. And, it gives you a better chance. I think I worded it this way in a blog post on maybe Friday or Thursday. If you can understand this, it gives you a much better shot of navigating through without emotion making the decision for you. That's a pretty important thing. I think I've got time to quickly answer a reader question. Someone asked, he said he's not really a conspiracy theorist guy, but, and this is true. Occasionally they do make you go, And he asked something about hedge funds and whether they, I don't even remember the question, if they're pushing stuff down or causing it to go up or whatever. And he asked, this is really the question is, do I follow that stuff and do I care about that stuff? Short answer is not really. In terms of understanding what's moving the market, when you see big moves start all of a sudden for no reason at all in the middle of the day, the market is doing one thing. If it's, chugging along flat and then it goes up. I think it was Thursday. We kind of had an interesting day where in the last 30 minutes the market whizzed higher. Why did that happen? Well, I don't really know, but to move that quickly, something triggered by programs. When you see very fast moves in either directions, it involves programming trading. It's kind of a market mechanics thing. Maybe there was something to cause it. Getting back to the explanation stuff. Maybe there's something to explain it, or maybe there isn't. I don't really care. But understanding what hedge funds are doing so closely doesn't really help my clients in any way. If there's demand, I think more of it, is there demand for certain things? Yes or no. And if there is demand, is that going to move it higher? If it's coming from hedge funds, there's no real way to know. But if I think that that's the case, for example, one trade that actually went well this summer sold out some Statoil in May at $43. It kind of was going up, and then it did one of those. And I took just a little, little off the table. And maybe it was hedge funds, I don't know. It was some sort of buying, and that's kind of what's more important to me is, some sort of abnormal buying. There's a precedent for that happening to Statoil in previous Mays. Maybe it ties in because that's when they pay their annual dividend. But just recognizing that there is a change, whether it's short-term or long-term, in the supply and demand. You can see it in volume. That to me is more important than where the demand is coming from the vast majority of the time. That's it. Have a good weekend.